Hello, everyone, and welcome to our latest Stanford Brown SB Talks podcast. Today is Thursday, July 21st, and I am joined once again by our Chief Investment Officer, Ashley Owen, to run his rule over the world. Welcome, Ashley.
Welcome all, wherever you are in the world. I'm at home today, but I haven't got COVID. So far, I've avoided COVID for the entire 3 years, so far so good.
Excellent. We will bottle whatever you have.
Sydney air.
Now, Ashley, 2022 hasn't necessarily been a pretty one across a variety of asset classes as we sort of pass the midpoint of the year. What's your take, I guess, on what's occurred in 2022 so far and possibly where we sit right now?
2022 calendar year has been a nice little negative year for pretty much not all asset classes, but most of the traditional asset classes and portfolios. We've had this massive speculative bubble run in a whole lot of things created by easy money and free money from governments and cheap money from central governments for the last post GFC 14 years. So that had to end. So one of the questions, we've had this sort of tech sell-off this current year in the last sort of 6 months. So one debate is this the next tech wreck 2.0 like we had in 2001, 2 after the great 90s bubble run? So far, we've had a bit of a correction. US shares are down 20-odd%. Australian shares are down 12-15%. That's actually turned around. It's funnily enough, the fears of rate hikes and accelerating rate hikes and accelerating inflation hit the market in the early months of this year. But every time, and we saw this a couple of times in the end of March, in the end of May, in the end of June, we had this spike because everything's bounced back 6 or 8% since the middle of June.
And the middle of May and middle of June was kind of Fed minutes came out. Everyone got into a bit of a spin with their views or their increasing concerns with inflation, and then the market sort of sold off mid-month with the release of the minutes, and then sort of rallied into the end of the month and then repeated again in June. Hasn't it played out that way in July at least? Yeah.
Well, it's still early days. It's actually doing exactly the same thing because shares have been up, 3% and another 1% yesterday. So what's happening, which is a bit counterintuitive, inflation fears drive markets down, both bond markets and share markets. But in the middle of the month, and we saw this in the last 3-4 months, apart from April was different. Every other month has been the same in that we've had this shift towards recession fear. So bond yields fall, which is good for bond prices, finally, and share markets rise. So you've seen this in the last week, US markets up 5%, Australian markets up 2 or 3 or 4%, because the fear has turned to recession. Now, why?
It's almost a repeat, though, of what we've seen over the last 10 years, where you had, people bought the bad news because the bad news was that the quantitative easing would have to go on longer, they'd have to print money harder, and the markets celebrated the bad news, bad economic news, I should say, because they thought monetary policy would be easier. It's a different take on it now, where it's just saying, well, maybe the rate rises don't need to be as aggressive as we'd previously feared if the recessionary risks are greater.
That's right. So you sell the rumor by the fact, or vice versa. So you saw that the last Fed rate hike was a big one, and the share markets were down leading up to the rate hike in fear of a big rate hike. Big rate hike came, and share markets jumped 2%. And when the inflation number 9 point whatever percent came out of the US the other day, share market jumped 3%. So it's one of those funny things. So it's best to learn to ignore these short-term ups and downs, because trying to make sense of it is just a waste. Life's too short. You can't control that, so don't worry about it. So the other major feature, which is different, you and I have been brought up, I started working in the early 80s, so it's 40-odd years now. And in that period of time, as it happens in history, we had this great 40-year period of disinflation, inflation going from double digits down to negative or zero last year. In that time, we've had this great condition where, not permanent, but simply temporary for that period, we've had this position where sell-offs in shares were countered by rises in bond prices and bond returns. So bonds, government bonds, high-grade corporate bonds, provided a good buffer against share sell-offs for the last 40 years, pretty much without exception.
Pretty much corporate debt's the best place to have been for the last 40 years. Yeah.
That's right. So corporate debt, because it's a bit higher coupon and yield than government debt, and it's a bit shorter in maturity, so it's less affected by inflation scares. So high-grade corporate debt's been the great asset class for centuries, particularly the last 40 years. when I say centuries, because governments defaulted regularly and governments are unreliable. So corporate debt markets are run back thousands of years to Mesopotamia. Corporate debt markets are far more robust and stable and deep than government debt markets. But although we talk to think that governments are risk-free, they're not. We know that now. So in this last 40 years, we've had a nice situation where bond markets, traditional government bonds, provided great buffers against shares. That only works when inflation is falling. And people tend to forget that every textbook ever written, that drives money in the world nowadays has been written in the last 40 years. It's all been written in America, some in Britain, some in Europe. But we've been taught in textbook land to think that bonds are a buffer against shares. They're not. It's only when inflation is falling that that's the case. Of course, inflation is not falling anymore. We're now entering a period of rising inflation. Whether it'll rise to 5, 10, 15%, probably not, but certainly higher than zero is rising inflation. So in that situation, when shares sell off for an inflation scare like this year has been, bonds also sell off. So bonds have not been a buffer at all against share price fall. So we've been out of bonds. About 70% of our defensive portfolio is not in bonds. It is in floating rate securities, which rise when inflation rises and interest rates rise. So we've been quite anti-textbook in that sense in the last year, in the last 2 or 3 years, actually. So that's the situation now. We've got shares and bonds, which are the two big asset classes in most pension funds around the world, selling off. As well as that, in Australia, and then around the world, particularly Europe and Britain, we've often seen a situation where share prices fall. Take the 87 crash. We had a massive crash in the 87, which is the big takeover boom in the 80s. What happened then was when share prices fell, central banks stimulated with free money, and that went into property. So when share markets are falling, property markets rose. And this has been same thing in the early 70s after the mining crash, you had a property boom. This time around, the thing that's causing the crisis is the rapid rise in interest rates, and that affects house prices as well. So this time we've got a coordination of house prices falling as well as bond prices falling, as well as share prices falling. So that's a bit different. And the reason for that is the speed. And you think of the speed of the COVID sell-offs and the speed of the COVID rebound, the speed of the unemployment spike and the speed of the unemployment coming down. That's now seeing the speed of this compression of the cycle of shares, bonds, and property all in one cycle, which we're seeing this year. So house prices is something you can never avoid talking about because there's 26 million experts that want to hear about and want to talk about house prices. So we'll cover that a bit today. Are they going to fall 30, 40%, etc.? So we'll cover all that.
If we talk about that cycle that we've seen in the last few months, and particularly centering around the release of the Fed minutes, the biggest concern or the biggest focus point has been just how stubborn the inflation numbers have been and continuing to creep up globally at present. Yes,
the inflation's something that's it's a weird thing because different baskets have different things in them, and every country has got 3 or 4 different inflation numbers, and do you base it on the last number or the compounded over 4 quarters, or is it this quarter versus the same quarter last year? There's lots, and you do it for core and trend and all these trim mean. There's lots of numbers. What is not ambiguous is the interest rate you pay on your mortgage. That's a number, and you've got to pay that next month or you lose your house. So that's far more concrete and tangible to talk about than where inflation is going. Because interest rates, of course, are a response to try and kill inflation. So the most common question I get is, how far are interest rates going to rise? And that depends on a couple of things. First of all, it depends on what is a theoretical target neutral interest rate that an economy should run. And there's by no means the Fed, the new deputy governor came out yesterday for the RBA, came out yesterday, 2 days ago, and said, we don't know, which is not very reassuring, but at least they admit
we don't know what our neutral rate should be.
That's right. But he did say what we do know is it's a hell of a lot higher than it currently is. Now, what most central bankers and academics know, but sometimes afraid to say it in the current zero rate environment, is that the neutral rate for an interest rate, for a cash rate in an economy, there's lots of theories, but essentially it is around about the rate at which the economy grows, the total pie grows. You've got to set it. If the pie is growing if real GDP growth is growing at 2 or 3%, which Australia will do for 100 years and has done for 100 years, 2 or 3 in order percent. So will the US. They're very similar economies. So that's a 2 or 3% growth in real activity and output and incomes. The inflation long-term target is probably something to do with a couple of percent, 1 or 2% in the US, 2 or 3% in the UK, Europe, US. So probably you add those two numbers together. If the real pie is growing at 2 or 3%, and the actual inflation in that is also growing at, say, 2-ish%, that means your total pie, the actual amount of flour and dough and meat in the pie, is growing at around about 4 or 5%. 2 or 3% for inflation, 2 or 3% for real growth. So that 4 or 5% is the neutral, non-inflationary rate that cash rates must be in order for the pie not to inflate even further. So that's a difficult concept. I mean, that's been written about 1,000, and Nobel Prizes have been written on that. It's called the Taylor Rule, and John Taylor is still around. He advised Reagan, he advised Clinton, he advised Bush. The Taylor Rule says that the long-term cash rate for an economy is something in the order of the real growth rate, 2 or 3, plus the inflation rate, 2 or 3, is about 4 or 5. Everyone knows that. Central bankers are terrified of actually saying that, because that means people will get terrified their 2% mortgage is suddenly going to have to go to 5% plus a couple for bank margin of 6 or 7%. Now, you and I know that pre-GFC, mortgage rates were 5, 6%. The average mortgage rate, top line mortgage rate, standard variable rate was about 7.5. The average discount rate was about 6. The cash rate was 4.75 pre-GFC. So we're all used to that. It's very scary to tell people that who've taken on a mortgage in the last 2 or 3 years, a mortgage to the hilt, and they put in 5% equity. They're paying now, they've got a fixed rate mortgage of 2%, and they're now going to be told when that rolls in 2 years to 5 or 6%. That's terrifying. It's terrifying because that actually changes their spending habits now, it changes behavior now, and that's the last thing people want people to stop spending and start hoarding now. So
there's an exercise going on in carefully massaging people's expectations to adjust slowly. It's the boil the frog approach to managing expectations.
So that's right. So nobody's denying that the cash rate in Australia and US should be something in the order of 4 or 5%. They're being very cagey about introducing people slowly to that, but they all know that. So that's the first variable. What is the neutral rate going to be in the long term? And the answer is going to be 4-ish% plus, like it was pre-GC, like it was for the last 20, 30 years. No big deal. That's scary for people with big mortgages now. The second variable is, if we can suddenly reduce inflation back to target, then that will mean that the cash rate will have to drift up to what I said before, 4-ish%. So the question becomes, if inflation is sticky, if inflation takes a while to come down, cash rates will have to be risen well above that in order to knock inflation on the head, like they were in the early 80s, like they were in the early 90s. So that's the second element. We know cash rates are going to go up to something in the order of 4-ish%. The question is, if inflation is purely transitory, purely temporary, the opening of the borders, the opening of Ukraine, food markets, export markets, if all of the coal-fired
China lockdowns,
China lockdowns in, all of those fairy tale things occur, then yes, inflation will drift back to 1 or 2%. Probably that's not going to occur. Probably there are quite a few things in there on the supply side which are shocks, yes, and temporary restrictions, yes. But China is not going to unlock its doors and start living again tomorrow. They're not. There's zero policy, and that'll take a long time for that. Xi Jinping cannot backtrack before he gets re-elected for life in November. So he's got to do a lot of things right. And one thing he's decided that he knows he's responsible for COVID in the first place. So he knows he must make up this story that they've controlled it. So he knows he's got to stick to the zero policy rule. Terribly damaging to their economy. It's crunching world markets, it's crunching commodity markets, and crunching their property market. But he personally has to stick to it to get elected emperor for life. He's got to do that by November. So these things aren't going to stop instantly. Ukraine is not going to go away. Russia's not going to go away. They're actually bedding down for a longer war, which could be, I mean, they've been in Crimea for 2014 and they're still fighting on the ground. It could be a long war. Nobody's got to lift sanctions quickly against Russia. So those things, he's not going to open Donetsk, he's not going to open the Crimean ports to farm exports tomorrow. So those restrictive supply side issues pushing up inflation in the short term are probably not going to disappear tomorrow or next month or next quarter. So in answer to the second question, we know cash rates are going to rise to 4-ish%. Secondly, since inflation is not going to be solved quickly, it's going to probably take cash rate rises well above target to knock inflation on the head, which will mean deep recession, job losses, bankruptcies in the street. And that's what you've got to do. In order to slow inflation, you've got to take money out of people's pockets, and you do that by taking away their jobs. So the purpose of rate hikes is to destroy business, to lay off staff, to slow demand in spending.
Sounds fair to say not all parts of the world are equal in this, though. Of course, we have Europe, who potentially in recession already, obviously much more vulnerable to it with the aging population. As you described, Australia and the US, slightly better positioned with natural immigration and more natural underlying economic growth.
Yes, I think that's right. The actual GDP growth number, I mean, America had a negative quarter in March quarter. It may well post a negative quarter in March. So technically people will say, aha, we're in recession. Well, that's nonsense. We know that. Recessions aren't the textbook. I mean, people say, well, a recession equals 2 quarters in a row of negative GDP growth. That's rubbish. I don't know who made that up, but it's always been rubbish. For example, in the COVID lockdowns, we had a 2 month, it's actually less than 2 months. The Fed called that as a 2 month, or the NBER, the National Bureau of Economic Advisors, which is the US body that declares recession. They said, well, we've had this 2 month recession, nothing to do with, by the time that was over, the market was already up and share prices already jumped back rapidly. So the obsession with an economic slowdown interests academics and media people, but it doesn't really affect investors. Investors are worried about to what extent it affects profits and dividends next year or 2 or 3, and that's what drives share prices. So if you're going back 6 or 8 weeks, when we had this mid-June, 4 weeks ago, sort of turnaround between inflation scares driving share markets down, and in the middle of the month it turned into recession fears.
Yeah.
So bond yields fell quite a bit, 80 or 90 basis points, which is a big fall in bond yield, which means bond markets have done well over the last 4 weeks. And then share prices have rebounded 6 or 8% since that low in mid-June, because they were saying, well, okay, the fear is now a recession. Profits are going to fall. Profits in America and globally are already flattening. We had this great growth in profits to rebound out of the lockdown recession. Profits are now $1 trillion total, aggregate, higher than they were pre-lockdowns, and they were growing at 10-15%. Now global profits they were growing at about 5%, which is quite a subdued profit outlook, and now they're flat. So we may well get a dip in profits. Now,
earnings seasons at the minute still remains reasonably solid, but you're painting a picture that's pretty aggressive, or very aggressive, on interest rates, therefore economically significantly challenged. What does that mean for share markets and investors in shares?
Well, it's interesting. Again, it comes back to what central banks do and how far they take it. Now, there's two, most likely, the thing that's changed in the world over the last 40 years, and particularly the last pre-GFC to now, and even pre-lockdown to now, is that the ability to raise cash rates back to where they ought to be is affected very much by the fact that there's so much more debt in the world. Debt in the world is double. I'm talking now, the low interest rates and the zero interest rates and the QE policies post-GFC created government debt. Quite deliberately, it was to fund deficits, to government debt. So that's doubled and trebled. Across the world, including in Australia, went from $0 to $1 trillion in debt, thanks to both sides, not just Liberals. That will also encourage corporates, companies to gear up, so they're gearing up to the hilt, and also households, particularly in Northern Europe, UK, Australia and Canada, which are the big household debt countries of the world. It's all this free money. So the ability to raise cash rates back to 4-ish% is now very much hampered by the fact that that'll cause a lot of pressure on government revenues to pay off interest as it rises, corporates and households. So there's 2 ways out for central banks, and the 2 ways to avoid that massive problem if they do raise rates to 4. One of the ways out is to, my belief is that you look at Jay Powell in the end of Christmas 2018, he said, I'm not going to have markets fall over. I'm not going to raise rates anymore. And he turned to cutting rates during 2019 and then in COVID. So the first way out is for central banks to say, we haven't got the guts to raise rates to cause big recessions, deep sustained recessions like the early 80s. So therefore, we'll just give up. That is most likely the way. So there's a lot of political pressure. Now, bear in mind now, in every country in the world, including Australia, we've got this very fractured political system. We thought Australia got out of that, but the last election showed there's no more two big parties. It's all about other things now, extreme left, extreme right. So every country, you look at Europe, you look at Italy last week, you look at Britain, you look at US with Trump, very, very fractured policies. You have the ability for governments to suddenly cut spending and raise taxes to get back to zero, to neutral, to get back to budget surplus, or at least neutral, is gone. They're not going to be able to do that. So governments have to borrow forever. So therefore, the heavy lifting has got to be done by monetary policy, by central banks to lift rates back, not just to 4, but to 5 or 6 or 7, in order to counter that spending from governments. So I think central bankers are going to, again, ultimately, they're paid and hired by governments. They're a government tool. They're not independent at all, never have been. So I think they don't have the political guts to actually raise rates to where it's got to be for deep recessions to take money out of people's pockets. So they'll give up. And that will mean we'll just stop, start. This is the stagflation idea that they're going to have to allow inflation to run higher because they haven't got the guts to raise rates to 5 or 10%, which it may well take to bring inflation back. The second way, and that's a deflationary 1970s, flared pants and mood rings. That's a dangerous stagflation where you've got rising unemployment, stagnant growth, and high persistent inflation because they haven't got the guts. Only when Paul Volcker came in 79, were under Reagan, under Carter, not Reagan, it was Carter that did the work with deregulation, structural reform, bringing Paul Volcker in. That was the deep double dip recession in the early 80s. I don't think that central banks have got the guts to do that again. The second way out for central banks is to say, who said we should target inflation at 2%? This is the Joe Stiglitz camp, which says, who made up this silly number in the first place? Who said that New Zealand should be 1%? Who said Australia should be 2 to 3%? Is a round number. It's not 2.64%, it's 2.00%. It's mad. It's a random number. It's arbitrary. It's meaningless. So that view says, well, let's just let's target a 4% inflation rate, or 3 to 4%. So that's an easy way out of getting to the same answer, but it's allowing them an intellectual or an academic shift in thinking to say, well, the academic world now says that it should be 4%. Let's make it 4%. So it's an easy way out to the same stagflation result. Underlying that, you've got this idea, which is that everyone looks at the inflation of the 70s and said, how did that get solved? And they say, we gave in central banks independence, starting with New Zealand, Don Brash, and we gave Paul Volcker the ability to raise rates and to bring it down to a 1 to 2% target, and in Australia, 2 to 3% target, only Bernie Fraser and Ian Macfarlane and the central bankers there. So the tendency now is to say, what solved inflation in the 70s? What solved the 70s inflation in the 80s was central bank targeting. If you say it quickly, that's correct. That tends to ignore the fact, or the alternate narrative is that, yes, that's true and it did work, but it wasn't the primary driver of lower inflation. So that gets you into thinking, what is the primary driver of lower inflation in the 80s, 90s, thousands? It was cheap stuff coming out of China, which is very deflationary. It is globalization and outsourcing labor, particularly manufacturing labor to low-wage countries. That's very deflationary. GATT, opening up trade barriers everywhere, lowering protection. It's anti-inflationary or deflationary. You have demographics, aging populations, rising welfare payments, lower spending, more focus on saving than spending. That is deflationary. So you have the petrodollar deal after the oil crisis in the early 70s, where oil exporting companies were forced into buying government debt to keep inflation low, to keep interest rates low, to allow the buildup of debt at low rates. That's deflationary. So yes, central bank policy, monetary policy was important, targeting, giving them independence, blah, blah, blah. But the primary drivers of inflation or the disinflation over the last 40 years have been these global factors, demographics, outsourcing, globalization, outsourcing, low wages. And you asked the question, are those still going to cause deflation in the future?
Mm.
It's been very easy to have a go at central bankers for being too slow last year and then waking up like a stunned deer and saying, we've got to attack. It's easy to make fun of them. But one of the reasons that they have been reluctant to act quickly with inflation has been quite valid, and that is they know this debt trap, this deflationary debt trap has been driving the structure down for 40 years, primarily demographics. And they're saying, well, we actually need a bit of inflation to get out of this debt trap. So they've been reluctant to try and jump on inflation because they know
they were happy to let the inflation genie out of the bottle,
because it's very hard to stop this deflationary engine slowing. Look at Japan over the last 30 years. That's a deflating, declining, decaying economy. So Northern Europe, or whole of Europe now, including Germany and Central Europe, central meaning the core of Europe, is deflating. It's getting smaller. There are fewer people, there are fewer taxpayers, there are fewer workers. So that is very deflationary. Plus, you've also got now, so central bankers are saying, what are those forces causing deflation? And will they still force deflation down?
Are they still there? Which many of them still
are. One by one, demographics there's very deflationary. The world is slowing. It'll peak at 10 billion people. It'll start falling. That is very deflationary.
Particularly led by the developed world, already slowed.
That's right. 75% of world GDP is in rich countries who are decaying. They're slowing, they're dying, they're aging, including Australia, Canada, US, UK. That's still very deflationary, and that's still going to be there. If you look at the other factors, it's not the case. The great outsourcing of manufacturing to low-wage countries, primarily China for the last 20, 30 years, that's reached its limit. Yes, there's some transferring. You look at Apple closing down in China, building them in Thailand and Vietnam and Indonesia. They are an Africa left, which is still the ultimate low-wage country area to be exploited. That's going to be a long, long time and hard work, so ignore them. I suspect that the ability to get the same gains from outsourcing to low-wage countries, that is much less powerful now than it was when,
I'll give you one devil's advocate argument to that and say manufacturing, yes, certainly. But
that's now starting.
But for services, services have largely been kept onshore. But the digital transformation in the world has made it easier, made lots of jobs that were previously not portable, very portable. And I give the example of I have a friend who lives in Sardinia and moved there, couldn't learn the language, couldn't get work for years, and then COVID struck, and suddenly he's working in the sales roles for US companies from Sardinia.
Yes, that's good. The other side, I suspect that is a one-off thing, and certainly COVID helped us.
It accelerated it. Yeah,
I suspect it's more powerful the other way. For example, you pick up a phone to any bank, any telco, and you talk to Philippines, very cheap, or India. Telstra, which is the biggest and ugliest, most hated company in Australia for a lot of reasons, has finally decided that that's actually bad for service. Hello, wake up. And they've now put all of their call centers back into Australia. So a lot of companies are doing that. So plus, in 2018, when Trump started his trade wars, that started a whole trend to unwind. It's called re-onshoring or nearshoring. So you come from Ireland. Ireland had this massive boom 20 years ago in call centers for American companies. That caused a massive bubble in Ireland in property markets, and they're still recovering from that now. So I suspect that global trend toward outsourcing has reached its limits, because the wages in China are now 4 or 5 times what they were 20 years ago. China's now, middle income company. It's not a country. It's not a low wage country. India is yet to be done. India has a lot of problems, which some of them aren't solvable. They're 20 years behind China for a lot of reasons, structurally, political. They're a democracy, not an autocracy. There's brownout. There's no property land system. It's a hard place to do business. It's possible, but it ain't no China. If you add up all the Vietnams and Thailands in the world, it ain't no China. Africa is going to be too hard to attack. It's going to be, China's trying to do that. And good luck to them. I suspect it'll take a lot longer, a lot harder than they think. So that demographic, that whole outsourcing, globalization, it's not stopped. but it certainly hasn't got the engine it has to drive.
It certainly isn't going to continue at the momentum that it previously did anyway. It's not going to be the deflationary force that it was. Yeah.
The other great deflationary force over the last 40 years has been technology and automation. The great technology automation changes in America, which is the engine room of the world, were steam engines in Britain, and then electric lights. Putting electric lights in homes and factories and offices created the idea of technology, computers post-war, and then silicon chips post-1980s. They were very powerful productivity gainers, which led to lower costs of everything, which is deflationary. Is that on the same deflationary trajectory, i.e. is productivity gains going to deliver 1 or 2% to economic growth every year like they have over the last century? The answer is it's hard to see. For a lot of reasons, as simple as this. Facebook, Instagram, Google has changed the world, no doubt. Has that led to people producing more widgets per day? And the answer is no, because they're sitting at their desk bloody Facebooking and Insta chatting or whatever they do. That productivity is negative for the world. So I'm being a bit facetious, but we're not going to get the electrification of offices that we got 100 years ago. We're not going to get the motor car revolution in the 1920s we had. We're not going to get, I don't think we're going to get those same productivity changes in the last century in Australia and America. They delivered of the GDP growth of 3%. In America, 2% came from productivity growth, people doing things better, more widgets per hour, and 1% came from population growth.
Yeah.
In Australia, we had the same 3% GDP growth, 2% came from population growth, but only 1% came from doing things better, productivity growth. So overall, about half of all growth came from population growth. That's gone. We're reaching a limit. 10 billion.
Albeit arguably Australia is still in.
Australia it is.
Still immigration. Yeah.
Our companies are global companies and we've got a global pie.
Look at the developed world. Yeah.
Secondly, the productivity gains of a 1.5% for the last century per year, I suspect it's going to take literally a new light bulb every decade, that sort of productivity gain to get those same engines of growth we got in the last 100 years. So that was a great deflationary force: automation, artificial intelligence, lowering the cost of everything, including labor. That is running out of steam, or it certainly hasn't got the same steam it had driving the last 40 years. So if you tick them off, demographics is very deflationary, that'll go on, no problem. Automation, technology, reducing costs, it's probably a much slower plane than it was over the last 40 years. Things like outsourcing, lower wage countries, those sorts of globalization benefits, they're not over, but they're not developing the same engine of growth and therefore the same engine of deflation for costs of goods. So this is why people are saying, well, we've had this great disinflation cycle of 30, 40 years, but probably 3 or 4 of those great underpinning deflationary forces are no longer as powerful as they were. So this is a case for saying, well, with this great period of low inflation, that's not going to stop at zero. That's probably going to edge up over time.
So you're painting a compelling picture for an extended period of more stubborn inflation, obviously higher rates, asking now to probably put your investor hat on and say, well, you've got your dollar to invest. What asset classes do you go to in this type of an environment to get a return? Also realizing that, well, actually inflation is going to be higher. Therefore, we care about real returns. Where do we put our money to get, to beat inflation in this environment?
Correct. So I think we've done a lot of work over literally 10 years about how asset classes work, how investments work in different environments, and the overall returns, real returns after inflation from all asset classes, all the major asset classes, including commodities and precious metals and gold, shares, bonds, housing, commercial property, they as a group will be lower in real terms. So for example, like wages will be lower. So for example, shares will probably return overall, ignoring current pricing, but the overall share market will probably return something in the order of 10, 11% total returns, capital gains versus plus dividends over the next 10, 15 years. But if inflation is, and that won't double if inflation jumps to 10%. So the real returns after inflation will probably be more subdued across all asset classes. Now, what we found was, even though the return from shares, commercial property, housing, etc., will be lower, the ranking of returns, the best, medium, and lowest returns, will actually be pretty much the same under all inflation environments. So at the top of the pie is, generally speaking, company shares, listed company shares, unlisted company shares, because companies in a lot of industries has the ability to pass through inflation to customers. So shares, and also shares are mobile. A company can choose to do business in this town or that city or that country. They can move around, they can change products. That's something, say, a commercial property can't do. When you're stuck in a town, you are stuck in a town. It's based on pure luck whether the town grows or dies. In Australia, we've been quite lucky because the big cities have always grown. Not so in Europe, not so in the US. So shares are the best ways of passing through inflation and surviving a high inflation environment. So shares do very well in moderate and slow rising inflation. They get sold off when inflation's high. They get spikes like in the mid 70s and the late 70s. But by and large, shares are the best place to be. Broad, diversified global shares are going to be, including Australian shares, are going to be a good place to be in any inflationary environment, particularly moderately rising inflation. Next comes commercial property. Why is it next? Next is because it's not mobile. Even if you own a diversified portfolio of properties, try and keep the gearing within reason. Gearing's pretty in rising inflation environment, high inflation environments. Gearing is good because gearing favours the borrower, not the lender. So gearing is good, but not too high. Housing is pretty good. Housing is always a good inflation hedge. Again, housing is an essential asset. It's typically geared up by people, so it does well in inflation environments. Bottom of the pile tend to be cash, fixed rate bonds, government bonds in particular, and precious metals, which, despite all the rhetoric and all the theory, are actually lousy inflation hedges. So if you look at all the returns,
you're not going all in gold.
We've used gold in portfolios. Remember 2018, we put it in, jumped 10%, did very well. So it's very good. Gold is mostly overpriced, and people tend to get excited by it after the price has risen. You buy gold when it's cheap in real terms, which is quite rarely. And gold is good inflation, good hedge against inflation scares, but it's not good. Gold peaked in the middle of 2020 when inflation was negative. Hit 1,900 an ounce, hit 2,000 an ounce. Now, gold's done quite well in Australian dollar terms because the dollar's fallen. The gold in US terms has been lousy, even though inflation has risen to 5, 6, 7, 8, 9%. So you think gold will do well? It hasn't. So gold is good against a scare of inflation, like in 2020, when it was zero inflation, negative inflation. But when inflation arrives, gold does poorly. And you look at through history, precious metals in general, because gold was banned for most of the 20th century in America, so it's hard to measure. Precious metals, platinum, silver are very similar. Those as a group don't do well in inflation environments, but they do well in inflation scares, which is very different. So in the other thing that's doing well at the moment is commodities. Now, commodities each of them have got their supply-demand cycles, and they've got things affecting, construction in China is affecting iron ore now. We've had a great bubble in the last year. It's come down because construction is in trouble in China. But you've got oil and gas and coal, which have been boosted by this energy crisis in Europe and the transition to renewables, and then you've got Russia as well. So if you ignore the one-off effects of supply-demand crunches within each commodity, as a group, industrial commodities are going to do well for a couple of reasons. One is because inflation flows through to commodity, or comes from commodity prices, which flow through to products. So inflation is going to drive commodity prices, or the demand for mining, exploration. That whole sector will do quite well, ignoring the ups and downs in each cycle, in each commodity. The second reason why industrial commodities will do well is because you've got this great Cold War tension rising, as we had in the 50s and 60s and 70s, which drove commodities into that mining cycle in the late 60s in Australia particularly. So that is going to be good. So the general military build-up is good for commodity prices.
Demand for iron ore and other core commodities. Can I ask, Ashley, just conscious of time, but we just touched back on that house prices thing, so you've sort of talked And environment-wise, still residential property should do quite well. Obviously, Australia's favourite asset, and coming under increased attention after having a phenomenal FOMO-driven run for the last couple of years. It's certainly showing signs of cooling. Any comments to make around your views on the property market?
Housing in Australia is particularly good because you've got this rising population, which will every government in Australia, green, black, blue, red, what colours every administration in Australia since white settlement has been pro-growth and pro-immigration. Some more so than others, but generally it's a very pro-growth country politically. I don't see that changing. And you look at the pressures now in wages is because they've stopped the borders 2 years ago. They realise that now, so they can open the border. Now, the RBA did say that 2 years ago. They said the way out of inflation is to close the borders. So as soon as you reopen borders, it'll take pressure off wages. And the policymakers, even Labor is starting to see that. Labor are traditionally a pro-union, anti-immigration party, but even so, they are fundamentally pro-growth and always have been. So that's good for Australia. So Australian housing concentrated in these big cities we've got no Detroits, we've got no Baltimores, we've got no Philadelphias. We have growing, diversified, remote cities, and that's good for housing if you're in those cities.
You've written historically to our clients about the trend of you get real growth and then periods of real prices sort of stagnating and then goes on another run again.
Yes, it's driven by interest rates. So you look at, say, this, people say, oh, look, what if house prices fall 40%? Well, they've grown 40% apart from Perth, which has only grown about 15%. In the last 5 years, house prices, the median house price, which is a funny measure, but take it what you will, the median house price in Sydney, Melbourne, Brisbane, even Adelaide, and particularly Hobart, has jumped 40 to 50% over the last 5 years. So if you lose that, so what? I mean, no one's buying and selling a house every day. I've got no home loan.
Well, it matters to you if you bought that house 6 months ago.
The marginal buyer who bought a house, who listened to Philip Lowe at the RBA and said, we're not going to raise rate for 3 years. And they said, oh, okay, I'll go and buy a house now. I said, all of a sudden, boom, rate rises and many, many to come. So people who bought that promise or bought that expectation, that very carefully laid expectation of no rate rises, the intention of that was to lure people in. What did it do? It lured people in, got them geared up on cheap loans, which is the intention of rate cuts. Probably the RBA did it a bit too, it gilded the lily a bit.
Yeah, way too much.
But taking that away, it's the intention of rate cuts to lure people in to borrow and spend, because that creates jobs, which creates activity. So that's the whole intention. It worked. Unfortunately, people did rush in, bought places, too much debt. So for those people, it'll be painful. Australians have got a remarkable habit of, unlike America, where you can hand the keys back and say it's yours if you've got negative equity, Australia, you don't. If you can't hand the keys back in Australia, if your house is worth, you bought it for $1 million on 950,000 worth of debt, or 900,000 worth of debt, which a lot of people did, crazy numbers, I know, but they did. If that $1 million house drops to 800,000, so what? The so what occurs if you can't make the payments. In Australia, you've got a lot of ways of making payments. They work 3 jobs, they borrow it from mum and dad, they borrow it from friends. Australians don't give back their house lightly like Americans do. So I suspect that at the margin, there'll be a lot of pain, but by and large, we'll avoid a mid-2000s type meltdown in America, where house prices in America drop 40, 50%, some cases much more than that. And the borrowers, and 14 million borrowers, said, here's the keys, your problem, that you can't sue me. Australia, you can be sued and you'll be pursued to the rest of your life. Yeah. So it's a very different world here. I think we'll be okay. But where we will have problems is residential property developers. It's generally the developers that get hit. And I'm talking about bank losses. I don't care about other people's losses, but bank losses, which affect share markets, because banks are a third of the share market. Bank losses are hit more likely by property development loan losses, and they're starting to appear. A few builders have gone down over the last 18 months, particularly this year with the commodity prices rising, building products rises, fixed price contracts. We'll see a lot more builders go under. We'll see a lot more property construction firms go under, highly geared, highly leveraged, inability to raise prices because they're already locked into contracts. So it's at that level, as it was in the early 90s after the late 80s property collapse. That's going to be the developers. And yes, there'll be marginal borrowers who bought 10 flats off the plan with too much debt. They'll be wiped out. But that's going to be it's not going to be a GFC type housing crisis in America, like the middle of the 2000 decade.
Very good. Now we've reached the end of the quarter. This is investment committee asset allocation time. We meet next week, and then we will make our decision in terms of how we're positioned for the quarter ahead.
Yes, we'll probably make a couple of fund changes. I don't. It's hard to say. We'll obviously meet and discuss it, and we'll communicate what we're doing. The share market's down, bond markets are down. We're not in bonds. We're in Australian shares and global shares. We didn't gear up. We have no gearing. We have no derivatives. We have no shorting. We have no stock lending. We didn't get into the tech bubble last year. We have no crypto. So we avoid all those things. We are pretty safe, boring investors, which is, it's a hard story to sell in a bubble where everyone's going mad. But we want to be there in 20, 30 years when you need the money. So we're not going to get carried away by gearing up at the tops of bubbles and we have none of those speculative things. So we're going to be there with pretty conservative holdings in 5, 10, 15, 20 years time. And that's our aim.
Excellent. Well, illuminating as always, Ashley. Thank you very much. And I'll let you get back to your reading.
Fantastic.
Take care. Thank you all. Thank you to all our listeners, and have a good day.
Bye-bye. Thanks.
Goodbye.